Good afternoon, everyone. I'm hoping that we can maybe have share some good information with you today. We're going to run through a couple of updates in funds, some of the trades we did the last couple of weeks and months, just some changes in money markets, as well as just some other thinking, as well as giving everyone the opportunity to ask any questions that they may have. If you do have any questions, just follow those step-by-step instructions. Click on the more panels. Just ask the questions. Questions will come up, and I will answer them as they become available. If we can move to the presentation. So over the last couple of years, we've seen a pretty significant rise in the fixed income assets managed by Ashburton. From when we joined in January 2016, when it was just over 4 billion, as of the end of the financial year, it was just under 30 billion, and as of yesterday, it was slightly above 30 billion in just the fixed income space. If we add to that the various alternative asset classes, which mostly sit in LDI or liability-driven investment portfolios, as well as in credit portfolios, that pushes it up to about the mid 50 billion, all in the fixed income and fixed income related assets. Just a couple of updates from a personnel and staff point of view. Today, so I myself can talk to you, and we're going to try and give Kgothatso and Nyabela, who's the lead portfolio manager on the money market fund, an opportunity as well. However, Kgothatso is having some computer issues, so hopefully we can get those sorted before it gets to her section. Michael and Mohammed also forms part of the team with me. We had 2 staff departures that has worked with me now for the last 8 years. Eleanor Lawrence has left and Heather Jackson's left. But to fill in those roles, we've managed to recruit internally. Ringatani Nglovo, or Ringi, has become the lead portfolio manager on the impact funds, specifically the Jobs Fund, which we run in concert with National Treasury and the South African Jobs Fund. Another promotion internally was a lady by the name of Santhuri. She's now heading up the credit risk process, and Cornelius changing his role slightly, still head of credit, but both credit portfolio management as well as credit risk. We are also looking for a new credit analyst. So if you know of any credit analysts looking to join a pretty strong credit team, we're looking at the junior to mid-level, anywhere between 2 to 4 years experience in analyzing organizations and companies, either equities or fixed income. Kgothatso's the one in the team that's been here the longest. She's been here effectively since the start of Ashburton, and she's been with the group for a while as well. Today we're going to focus just on 3 portfolios briefly. Most of the focus is going to be going into just some of the changes in the money market fund, but also we can discuss some of the trades in Ashburton Stable Income. Those are our largest 2 portfolios. We'll also be discussing Ashburton Diversified Income, some of the trades that we've done there, how we've done in the months since the end of March versus our peers. And just we're going to talk a little bit about different types of income funds and why an income fund is not always comparable to another. So briefly, we're familiar with the characteristics of a money market fund. Kgothatso will go into the characteristics of ours. We will compare that to the stable income fund and talk about both of those in context and what they look like. We've added to this the pack, which will also be sent out. Just the details, fee classes, etc., of all the portfolios in one space. The one exception there, the Ashburton Bond Fund, which most of you will have access to, is the L class, and we can get we'll add information there as well. For Diversified Income Fund, our retail fund class is the B class, not the A class. So if you are looking performance numbers, those are the correct ones. And stable income, as you can see, the L class and the C class. C class is across the board is for institutional investors. That's for any single investment of 20 million rand or more by a single client. or fund or portfolio. So to talk through briefly the fund information, we're going to start off here. Kgothatso, the moment you're on, please let me know. Otherwise, I'm going to go ahead. So the Ashburton Money Market Fund is the most conservative fund that we run. In fact, we run the Ashburton Money Market Fund in the most conservative way we think it's possible to run a money market fund. The fund's primary objective is liquidity, safety, and then to provide returns for investors from that very safe, diversified portfolio of assets. At the start of this year, one of the changes we made was to remove any and all non-bank credit from the fund. So the fund only invests in the big five South African banks and international banks with local deposit allowances. So effectively, the only things in there are AA rated South African banks, AAA rated government, and above AAA rated international banks. So the credit rating is AA. We are awaiting a credit rating that we did recently. So in the next day or two, we will actually have new credit rating available, and we will share that with everyone as soon as that's in line. Just a couple other things. If you come directly to the Manco, the money market fund offers T+0 liquidity. So if you put in your request for liquidity in the morning, you'll have your money back in your account the afternoon if you do your request before 12. If you do it after 12, it'll be in your portfolio the next day. The benchmark is the STEFI 3-month index, and we try to outperform by about 0.5% per year there. Both board notice 90 and Reg 28 compliant, and income is paid there monthly. So this portfolio invests in a variety of assets, right? Fixed rate instruments, floating rate instruments, and also various types of issuance. Historically, this type of fund would have had a significant overweight position to bank paper. However, one of the things that happened recently is with banks being relatively well funded and Treasury, National Treasury through the SARB, looking to raise more funding, what's happening is that we've been increasing our Treasury bill or T-bill allocations to the portfolio. So you'll see there for the moment that 37% of the portfolio is actually invested in T-bills. And it's because, like for like, a T-bill gives anywhere from 30 to sometimes even 50 basis points more when compared to an NCD. Two of the primary restrictions that these funds have to comply with is duration. We're all familiar with what the term duration means. To put in perspective, the All Bond Index, the ALBI, has a duration of about 6.5. The duration of the money market fund needs to be below 0.25% or about 90 days, and it's currently sitting at about 85 days. The other restriction is weighted average life. Now, weighted average life is effectively just weighted average maturity. It's the weighted average of when all of the various instruments mature in the portfolio. That limits about 120 days in general. Specifically, the fund is currently sitting at 94 days, which is 3 months, which means half the maturity matures every 3 months. Effectively, at the moment, that means that 6 billion rands worth of instruments needs to be matured, rolled, and traded every 6 months. Every 3 months. 2 billion a month, 500 million rand a week. That is what Kgothatso keeps itself busy with, ensuring that on all of those trades and on all of those bookings, we get the best rates and ensure that the fund liquidity and performance remains in line. We do have quite a few very large clients in here, anywhere up to around 1 billion rand, as many of the clients in here are actually large corporates that access it either via FNB or via RMB. So one of the things we did at the start of the year was we realized that most of our client base, when they are investing in a money market fund, they're doing it because they're looking for the most conservative option that they have access to. And that is specifically true of many of our clients within the larger First Rand group. So what we did was we started a process whereby we removed and let mature all of the various non-bank credit instruments in the portfolio. So, for example, you'll see in October last year, there were a couple of things in the portfolio like Telkom and Foschini and Growthpoint, Mercedes-Benz, etc. And now many of these were either AA or AAA rated, but many South Africans have a preference for both the stability and the liquidity that investing in the large banks provide. So at the moment, you can see that the fund is effectively only invested in national government, T-bill paper, the big five South African banks, and then AAA rated international banks. To put it in perspective, HSBC and Construction Bank of China both have ratings in the A, around about the A minus space, or effectively 4 to 5 notches above the South African government, which puts them at about 6 notches above FirstRand and ABSA on a credit rating space. So adding those foreign exposures significantly reduces both single bank risk and credit risk in general. So just broadly, there are two primary types of money market funds in the South African market. You've got your corporate money market fund as a category, which is now pretty similar to what the Ashburton Fund looks like. Invest only in big five bank paper and similar. The normal and more vanilla money market fund, which also invests in more corporate credit. And we've decided to pitch our portfolio at the more risk-averse client set rather than trying to gain an extra 10 basis points or 15 basis points by investing in vanilla money market portfolio. I've just got a notification that Kgothatso is also now on, so I'm going to shut up for a second. Kgothatso, apologies, I'm at this slide. I'm going to let you please take over from here. Kgothatso, we can't hear you. There seems to be still some IT issues. Given that, I will move on to the next slide as well. Apologies for that. So, effectively the last slide is the characteristics of the three funds compared to both stable income. Now, stable income is a portfolio I've been running now for the last over the last decade. I started running it in September 2009. And the difference between that and a money market fund is that a money market fund has a 13-month instrument limit. The stable income fund practically has no limit. We don't, as long as all instruments have a fixed maturity date. On average, about 95% of the instruments in the portfolio has a maturity date of about 6 years or less. And the weighted average life is currently about 2.7 years. The stable income fund's also for a longer term client. Capital stability and high income is important. Since I've started managing the portfolio, we've not had a negative month. Just from a risk point of view, if a corporate money market fund has very low risk, another money market fund has low risk, stable income has low to medium type credit risk. Unfortunately, that's most of Kgothatso's section, but I would like to just introduce herself and to tell everyone just where she comes from and how long she's been here.
Again, apologies for that, and I'll go ahead and introduce myself. My name is Kgothatso. I have been with the First Fund Group for over 10 years this year. I have managed the fund since 2016 officially, unofficially since 2014. Probably Albert used the line of I'm the longest serving member of the fixed income group, and again, apologies for the IT faults on my side.
Thanks, Kgothatso. If you have any questions about this, specifically if you have business clients, corporate clients that might be interested in something like this, as a step out of a bank account, we find that a lot of them are interested in this type of product. The other types of funds that also use it occasionally are pension funds, etc. just effectively why the Ashburton Money Market Fund. It's a low volatility solution for short-term investment. It's an alternative to bank deposits, easy access, and extremely liquid investment. So stable income is our largest portfolio. It also has a credit rating. It's rated AA-, so it's a notch below the money market fund. The fund size is about 16 billion. It does not have a T+0 liquidity possibility. All flows are T+1. And we manage the fund in order to give clients an experience as close to possible as a money market fund would give them. So if we look at performance numbers, the fund had a little bit of a performance hiccup in March. Performance was still positive for the month, however, and if we look at these are our primary peers. It's large funds that don't take significant duration risk or no duration risk, and that for the most part are rated. Not all of them are rated, but even those that are not rated, I've also added in here just for reference. And you can look there both over the 3 and 6 months periods, as well as 2, 3, 5, and 7 year periods. The fund outperforms most or all of its peers. So just to talk a little bit further about the stable income fund and to set some expectations, over the last 5 years, stable income fund is that blue line, and the green line is CPI +3, so inflation +3. And we can see that the fund has outperformed inflation +3 over the last 5 years. What is important to note is that we don't expect the next year or two to look similar. We still expect stable income to give you a smooth return profile, but with interest rates being as much lower as they are, we expect that the return rate is going to be somewhere between inflation +2 to inflation +2.5. If we see further rate cuts, that might fall to inflation +1.5 to inflation +2 to inflation +2. But for the moment, we expect that inflation +2 to be kind of your midpoint, and maybe a little bit above or below that line. We could also see just the various types of income funds in the categories, right? So if you look at the last 12 months, right, that red line is the benchmark for money market portfolios. And it's generally the experience that clients that invest in money market portfolios receive, with the exception that the money market fund outperforms that line by about 50 to 60 basis points a year. Stable income is that blue line, and we can see that there were slight drawdowns during the course of the year, but it still did a pretty decent return number. If you look at some of the other funds that are also called other income funds or sit in the income category, for example, another popular fund in the category is the SIM Enhanced Yield portfolio. And the reason I've got these funds up on the screen is just to talk through the different types of portfolios that people often get use out there, and just to put what the various funds are into perspective. So if we look at, for example, the SIM fund, it had a good performance track record. But in March, for example, the fund was down some of the order of 2 to 3%. Now, it's a perfectly fine fund. I know the portfolio manager well. But there's a difference in client segment that is willing to take portfolio losses to those that are not. Even through the crisis, and every crisis the last decade, every month Ashburton Stable Income has had positive performance, and that appeals to a specific type of client. We expect that the fund is going to give you, like I said, CPI +2 to 2.5 to translate that into normal numbers. We expect anywhere between 5 to 5.5% over the next 12 months from Ashburton Stable Income. The other funds that often get compared as well as the Coronation Strategic Income. I use it because it's the largest multi-asset income fund in the category. But once again, this is now different from all the other three funds because it uses property preference shares or can use preference shares. It uses offshore assets. It uses bonds, etc. And the risk return profile of that fund is once again more risky than the others. Given the environment that we find ourselves in now, however, these types of funds are likely to do well. They're likely to outperform. And let me give you, and I'll give you that in examples a little bit later. Just quickly to talk about the holdings in stable income. FirstRand, Investec, Standard Bank, Nedbank, and Absa are the top 5 holdings. This is all bank paper. Then you've got the Ashburton investment grade portfolio, which is investment grade credit. And that 4% includes about 28 different names. So it's a very, very well diversified investment grade portfolio with all the credit in there being investment grade credit originated by RMB to its corporate client base. So it's very well originated, very well managed corporate credit. That's not available in the rest of the market, and it gives you significant diversity compared to its peers. The next largest holding is the Ashburton Money Market Fund, followed by BNP Paribas. It also has a AAA rating. When we did this purchase, BNP Paribas in 3 years was issuing a JIBAR plus 150, and the South African banks was issuing in 3 years a JIBAR plus, between JIBAR plus 50 to JIBAR plus 60. So about a 1% pickup, even though BNP Paribas is rated 5 or 6 notches above the South African banks. The next credit holding is Kgothatso, which is also a combination of various RMB originated instruments. And then our first effectively corporate credit counterparty is Discovery at 1.79%. Now, we understand obviously it's a medical aid, it's an insurer and various other things. So it is closer towards and moving more and more to being a bank as well. But for now, we treat it more like a corporate still. And you can see there that Discovery at less than 1.8% is our largest single name holding. So this portfolio does not take significant credit risk. It is extremely well diversified and still extremely liquid. In this portfolio, we also have clients upwards of 1 billion, and we have to be able to provide liquidity for them on a T+1 basis. Okay, so let's briefly talk about the multi-asset income space. Up on the screen, we have our multi-asset income offering since the end of March. So Ashburton Diversified Income from the end of March as to yesterday did 10.25%. We can see there that most of our peers did a little bit less than that. And we are very happy with the returns we've managed to get during that period. As part of the disclosures, March was a very difficult month for the Diversified Income Fund, but we have managed to pull back most of our underperformance in that period, and we've managed to pull back in a very, very difficult environment, pull significantly ahead against our peers. These, by the way, are the 10 largest other funds in the country. So these are who we consider to be our major peers, and I'm sure you will recognize many of the names there. And you can see we've pulled ahead between 4% or 5%, depending on who you compare us to on this chart. Just to put that in perspective versus our own portfolios, once again, over the last 6 months, the flat line being money market type returns, stable income being the blue line, and Ashburton Diversified Income being the green line. Now, I want to spend just 1 or 2 minutes talking about this. We expect that multi-asset income funds are going to outperform your cash funds quite significantly, at least for the foreseeable future. Given how low cash rates are at the moment, and given that, for example, the real yield on a 10-year inflation-linked bond is higher than the nominal non-real yield, or effectively just normal yield on a 1-year NCD, given that you've got bond yields sitting at anywhere between 9 to 10%, even at the short end of the curve, means that we think that specifically these types of portfolios that can take advantage of all of those asset classes will outperform the normal cash and stable income funds. And I think we've shown over the last 6, 7, 8 months that there's a very strong case to be made for this portfolio specifically. It is on all the various lists, so it can be accessed. For the month of November, thus far, we're up, I think, 1.5% in November. But one of the things to note here is that the bond market and the currency market is likely to remain very, very volatile, which means that additional performance in this category is likely to come at the cost of increased volatility as well. So just our views on the current areas and what we think return ranges are for various asset classes. We still have an overweight position on bonds, although we have reduced bonds quite significantly. All of the various portfolios run by the Ashburton, from the multi-asset income funds to the bond funds to the balance funds, were all heavily overweight bonds for the last 6 months. And now at the start of November, we reduced those bond positions. We're still slightly overweight bonds, but we are much more neutral now than we were a month ago. As you can see there, we expect bonds to give you anywhere between, let's call it 3.5% and 10% over the next 12 months. And our preference on the bond curve is between 3 years and 12 years. The back end of the curve has just been too volatile, too unpredictable, and there's too much fiscal risk in South Africa at the moment for us to really justify sitting at that end of the curve. In the linker space, we are neutral linkers. We expect that linkers will give you between 4% to 8.5% over the next 12 months. And once again, we prefer linkers the shorter end of the curve, 0 to 7 and 7 to 20. Although in practice, we don't actually like linkers beyond the 10-year point. So from the 2025s all the way to the 10-year linker is probably the only areas on the curve where we really are buying and adding to the various portfolios. When it comes to money market and credit, we are overweight investment grade credit from a asset class point of view. But the base rate of JIBAR being as low as it is means that we're underweight credit underweight for the entire asset class. Because JIBAR or 3 months JIBAR is going to be somewhere between 2.75 and let's call it 3.3% for the next 12 months, which means that investment grade credit is going to give you between 4.5% and 5.5%, which is significantly less than the return ranges of the other asset classes. If you can buy credit, for example, on a different base, so corporate credit bonds, fixed rate bonds, those kind of things, or if you can do some structuring or maturity transformation or total return swaps or portable alpha trades, that takes advantage both of the bond curve as well as the nice spreads that's available in the investment grade market. Those are some of the best trades to look at for the moment. We're still underweight property, although we've also now at the start of November started to slightly add to property. We're neutral preference shares, although the only prefs we really buy are the big 5 South African banks and Discovery, and those are all yielding between 9 and 9.5% at the moment. And then offshore bonds with low international rates, we're still underweight. So broadly, we've been increasing credit allocations to stable income over the last couple of months. We entered 2020 with a very low credit allocation, but we have been increasing it since about September. We've been very opportunistic in that space, buying in the secondary market, participating in private placement, but not just adding to credit across the board. We've reduced overweight duration positions, and where we've been selling bonds, we've had a preference for selling longer-term bonds compared to shorter-term bonds. And over the last month, we've also been buying a little bit of dollars into rand strength. And that's one of the other things that the last couple of slides I just want to talk to. So this slide shows you just the move on the SA 10-year. You can see we are now trading at the lowest levels that we have since the end of May. And as a result of that, we've reduced bond holdings. There are still significant fiscal risks in South Africa, and we think that investing closer to towards the front end of the curve is preferable. There's less volatility there. There's less duration risk there. And as a result, we think we'll do better there as well. There are also some other factors that help you with the bond return profiles, things like curve roll down or slide. The other thing that's meaningful to just talk about is the Rand. As we speak, the Rand is trading somewhere between 15.15 and 15.20. Looking at the long-term trend of the Rand from 1995 to now, the Rand is trading effectively on that average red line. Now, from a historical perspective, it's important to note a couple of things. Firstly, that means that the Rand is, if not fairly valued, it's approaching fair value. Firstly. Secondly, every prior crisis that we had, where the Rand sold off sharply, right through the fair value number, both in 2004 and in 2010 and in 2018. In 2018, it's important to note this was largely true because of what has been termed Ramaphoria at the start of that year. It remained in place for about 6 months and then it retreated. And in fact, if you look at the last, effectively at the last 7 years, the Rand has traded either in line or above with its long-term trend line almost all the time, except for that brief period of Ramaphoria. As a result, at these kind of levels is probably levels if you've had clients where you've held off from moving monies offshore, from buying dollars. While it's entirely possible that the Rand can go to 13.90 or below, these are the kind of levels which is on a long-term fair value trend. So you are no longer buying or selling at peaks. The last time we were at these levels relative to that red line was in January, when we were trading at, I think, about 14.25, and trading now between 15 and 15.20 is probably a relatively similar kind of level, given the long-term trends in inflation differentials. That just gives you a picture of the Rand over the last 12 months, but just in a little bit more detail, showing you exactly how close we are to that long-term trend. And if there are no questions, okay, we've got a question here from, how concerned should we be about the National Assembly debate on a motion of no confidence in President Cyril Ramaphosa? I don't think we should be too concerned about it. It's never happened that the ANC votes out a sitting president. But I think it's going to be an interesting debate what I mean by that the ANC votes out a sitting president, they've never done it outside of party structures, is what I mean. At most, it might be embarrassing to the president. The downside is that he might be able to say other things and it might bring other people to light. So I'm not overly concerned about the National Assembly debates. I'm much more concerned about the things that, for example, that SAA keeps on getting bailed out, that you don't see the job cuts and things that you need at SABC, that there's now news coming through that they want to add a TV license to Netflix and enforce a 30% local content discussion. So it's a difficult. I mean, there are other more structural things that have me more concerned about the direction of travel. These kind of debates on a motion of no confidence has never been as eventful for the ANC as we would have liked to believe. Any other questions? Okay, so for just those that wanted to know, I've got the charts on the screen. Over the last 5 years, Bitcoin is up 3,900%, or 100% annually. Over the last 5 years, Tesla's up 1,000%, or about 65% per annum. And Tesla's currently trading at $574 a share. So that's interesting. Any other questions on markets or portfolios or anything else? Okay. Given that, this is our last session for the year. If you have any questions or queries or anything else, please direct them to the BDMs. If you have anything that you want us to discuss in any of these sessions, please let me know. Whether that be technical concepts, fund concepts, or economic concepts. I'm more than happy to prepare in advance and to do a more specific type of presentation, or at least more targeted. Our next session is only going to be at the end of January. So I hope to see you all again soon. And thank you very much for joining, and thanks for those that keep on supporting us. I hope everyone has a good and safe vacation, and everyone enjoys a little bit of time off. Thank you very much. Goodbye.